Being hard up financially sucks. I've been there and I hated it. The anxiety you get from not having enough money, spending too much on credit cards, and that sinking feeling you get from knowing that you're just not investing for the future. I remember being dead broke after university and going to the cash machine and seeing insufficient funds. It's actually because of these experiences that I went to work in the investment industry for the last 15 years. And now I want to pass on the lessons I've learned to help you avoid the mistakes that I made that kept me poor for longer than I care to admit. I need to warn you, this video is going to contain some cold hard truth bombs. So if you're looking for a cuddle and for someone to tell you that everything's going to be okay and to give you some comforting lies, you should skip this video. If you're ready to take massive action that your future self will thank you for, then keep watching. Let's get into it. Hi, I'm Stephen White, a chartered investment professional, and on this channel, we discuss tips and strategies to help you become a more confident, effective investor and build your wealth over time. Today, we're discussing a hugely important topic that holds people back from financial success. That is investing habits keeping you poor. Investing is like a lot of things in life. It takes practice to do it well. If you want to be a great musician, you need to practice, or you'll sound like this. If you want to be a doctor, you need to practice, or you'll do this. If you want to be an athlete, you need to practice, or you'll look like this guy. Investing is no different. You need to get your reps in.
1002.
Mr. Burgundy.
1003.
Whether you're looking to save for retirement or build an emergency fund, accumulate assets to start a business, investing should be a regular practice and discipline, a vehicle for achieving your life goals and ambitions. So here are 7 habits to avoid if you want to invest successfully and build your ideal financial life. Number 1, delaying investing, not investing early and often enough. Not investing from an early age is undoubtedly a massive unconscious act of self-sabotage. Let's compare the investment outcomes of 2 individuals, Alice and Rob, to illustrate the significant impact of starting investing early versus starting investing later. Alice starts investing at the age of 25 and contributes $200 per month to her investment portfolio. Rob, on the other hand, delays his investing journey until the age of 45 and also contributes $200 per month to his portfolio. Both invest in a diversified portfolio that generates a return of 7% on average. Assuming they both retire at 65, Alice, who's been investing for 40 years at $200 a month, will have made contributions of $96,000. Rob, who's been investing for 20 years at the same level, $200 a month, will have made total contributions of $48,000. Here's the kicker. Thanks to time and compounding, Alice will have amassed a total portfolio of $769,000. By contrast, Rob's portfolio will only be $127,000. This illustrates just what a valuable asset time is. Time in the markets is more important than timing the markets. Number 2, chasing quick profits. This is another bad investment habit guaranteed to keep you poor. Many people get lured by get-rich-quick schemes and hot stock tips, but the truth is, successful investing requires a long-term approach. Numerous studies have shown that somewhere between 70 to 97% of day traders lose money, depending on the asset class or market traded. Frequent buying and selling of stocks or other speculative investments can rack up transaction costs and lead to poor decision-making based on short-term market fluctuations. Incurring excessive transaction costs will definitely eat into your returns. In the industry, we call this overtrading. There is some appalling and frankly irresponsible advice on YouTube, TikTok, Instagram, and other social media channels. And every day I get illegal financial promotions advertised to me through social media. I'll do another video on that soon. Please avoid anything that looks like a get-rich-quick scheme. If it looks too good to be true, it almost certainly is. Hey, quick one, if you want to make a really smart investment decision, go ahead and click execute on the like and subscribe button. That way you won't miss out on future investing tips and insights. Plus, it really helps the channel. Thank you. Number 3, following the herd. Jumping into investments because everyone else is doing it or for fear of missing out on a hot trend is another surefire way of keeping yourself poor. In the investment industry, we joke that if it's in the news, you probably missed out on the opportunity for juicy returns anyway. Following the herd has also been bad for many crypto investors. Too many of my friends lost money in Bitcoin and other cryptocurrencies in 2021 when the market was going up exponentially. People thought it would go on forever. But of course, nothing can go up forever, and it crashed badly. there was murder on the dance floor. I remember one friend who's a prominent Bitcoin influencer saying, holding is gaining. He could not have been more wrong. He lost several $100,000. That is just plain bad risk management. Any asset where the price does this is likely in a mania-driven bubble. Joining the herd will likely end in heartache and the impoverishment of your portfolio. Number 4, lack of diversification. Putting all your eggs in one basket is risky. Relying heavily on a single stock or asset is the equivalent of betting it all on black and can lead to significant losses if that stock or asset performs poorly. Diversifying your portfolio across different asset classes, themes, and markets helps mitigate risks and gives you multiple chances of earning capital gains and dividends and distributions. Most people aren't investment professionals and they're not trained to do effective fundamental or technical analysis. So it really is better to delegate your investments to a competent, trained investment professional, or just buy diversified funds and ETFs or risk-rated whole portfolios. Number 5, not understanding asset allocation. Allocating your investments effectively across different asset classes like stocks, bonds, commodities, real estate, infrastructure, based on your investment goals and your risk preferences is crucial for long-term portfolio growth. Studies have shown that asset allocation explains over 90% of the variation in portfolio returns. Other factors like market timing and security selection do have an impact, but all the studies seem to agree about the importance of doing effective strategic asset allocation. In plain English, you need to have the right asset allocation mix for your goals and circumstances in order to achieve successful outcomes. And putting all your money blindly in stocks or bonds or cryptocurrencies just isn't smart. Number 6, emotional investing. Emotional investing is another habit that can keep you poor, as letting your emotions drive your investment decision-making leads to costly mistakes. When I was younger, I remember my mum buying shares in Laura Ashley, famous for its floral designs and homewares. She loved their curtains and sofas, but the shares kept going down and down and down, and she waited for a comeback that never came. The company never recovered and eventually went bust, taking all my mum's money with it. Very sad times. That said, you shouldn't just sell every time the market or an investment goes down. Imagine you panic sell your investments because you see the market dropping. Later, the market recovers, but you've missed out on potential gains because you've been out of the market. It's important to stay calm, think long-term, focusing on the fundamental value of your investments. Number 7, lack of financial education and professional advice. A lack of financial education and understanding can be a major barrier to building wealth through investing. Many investors pay an ignorance tax or a naivety premium because they're less informed than professional investors, the so-called smart money. It's really important to continuously learn and improve your financial knowledge by talking to qualified financial advisors and investment professionals, reading personal finance and investment news, and watching videos from credible sources. Many investors hear from friends and family about a hot stock and they invest for fear of missing out. Buying an investment without doing proper research is a surefire way of increasing the risk of losing money. Consulting with a financial advisor or delegating your investments to a competent, qualified wealth manager or fund manager can save you the anguish of dramatic, depressing losses. To be a successful investor is actually relatively simple. You need to invest early and often, build an appropriate portfolio diversified across asset classes and securities, manage your risks, and ride out the waves of the market unemotionally. For most people, a good mix of stocks, bonds, and cash securities will do the job. If you want to learn more about investing wisely in different asset classes, why don't you click this video about a simple diversified stock investment you can make, or this video about how to invest smartly in cash securities. They are both belters packed with value, even if I do say so myself. Until next time, keep investing selectively and effectively.